Good afternoon, everyone. It's pleasure to welcome you all in our today's session. My name is CA Neha Khandelwal. I have over 7 years of work experience in the field of taxation. I had the opportunity to work with individuals and businesses as well, helping them simplify and manage their tax responsibilities with clarity and confidence. In today's webinar, we will be discussing about a very timely and important topic, capital gain tax planning, maximize returns, minimize taxes. So, in our today's session, we will be covering importance of tax planning for capital gain, difference between short-term and long-term capital gain on different kind of assets, exemptions and reinvestment strategies, practical tax planning tips as well. And I encourage you all to keep this interactive. Please feel free to drop your questions in the chat box. I'll be addressing all those questions in the end of the session. So let's start today's session. So yeah, let's start with the importance of tax planning for capital gains. Okay. So, tax planning for capital gains helps individuals and businesses minimize their tax liability by choosing the right time of sale and reinvestment. It ensures effective use of exemptions under the Income Tax Act, improves post tax returns, and avoids penalties due to non compliances, ultimately supporting long term financial growth. Okay. So basically, you can reduce capital gain tax legally, optimize timing of asset sale, enable use of capital gain exemptions, improves post-tax investment returns, avoids penalties and non-compliances, supports long-term wealth creation. Okay, so now let's discuss what is the difference between short-term and long-term capital gains. Okay, so basically, short-term and long-term capital gains defined with a lot of things. Basically, their holding periods and their other benefits, their indexation, their investment objective, tax rate. There are so many things. Okay. But the basic difference between the short-term and long-term capital gain is on the basis of their holding period. So short-term capital gain arises on short-term holding and long-term capital gain on long-term holding. And these periods are either 1 year or 2 year as per the classification of the assets. Okay. Next is indexation benefit. So indexation benefit is not available for the short-term capital gain, but it is available for the long-term capital gain. But in certain assets, it is not available in the long-term capital gain as well. So yes, if you are planning to sell your any kind of assets and you will be having gain, you need to think about the indexation benefit point of view as well. Next is exemption. So exemptions are limited, or basically there is no as such exemption on the long short-term capital gain, but there are multiple exemptions which is available in the long-term capital gain. So definitely, if you are planning to sell your any kind of shares, mutual funds, property as well, basically you can think from the exemption point of view as well. So I would suggest long-term capital gain will be slightly more benefit to you. Okay. So next is tax rates. So short-term capital gain usually taxes at slab or a special rate. Long-term capital gain is at a concessional rate. So yes, definitely in the tax rates as well, long-term capital gain is having little bit benefit as compared to the short-term capital gain. Next is investment objective. So short-term capital gain focuses on quick returns. Instead of long-term capital gain, focuses on long-term wealth. Okay. So basically, you have to decide what kind of future you are looking at. If you are looking for a short-term benefit, then you should go with the short-term capital gain, short-term kind of assets and all. But if you are looking for either basically for the long-term wealth creation, long-term your assets creation, in that case, you should go with the long-term capital gain perspective. So these are the basic differences between the short-term and long-term capital gains. Okay. Next is capital gains on different assets. Okay, so here I have written down the classification of your assets and their capital gain rates as well, taxability rates basically. So if we talk about equity shares, which is listed, so short-term capital gain will be taxes at 20%, but long-term capital gain is exempt up to 1.25 lakh. On top of 1.25 lakh, you have to pay 12.5%, but there is no indexation benefit in this. Okay. Equity mutual fund, same as listed shares, which we have discussed above for the short term one. Okay, that is 20%. For the long term, 12.5% on above 1.25 lakh. Okay. But if you are holding that mutual fund, in that case, short term and long term are taxes at the slab rates. Okay. Immovable property, in case of basically immovable property, so short-term gain will be taxable as per slab rate, but long-term capital gain will be taxable 12.5% without indexation. And there are few exemptions as well for the reinvestment under Section 54 and 54 for the immovable properties. For the gold and jewelry, short-term gain will be taxable at per slab rate. Long-term gain will be taxable 12.5 without any indexation and without any limit as well. There is no as such 1.25 lakh rupees limit which we have mentioned in the equity shares. For bond and debenture, short-term and long-term capital gains are as per slab rate. For unlisted shares, short-term capital gain are as per slab rate, but long-term capital gain is 12.5% without indexation. So here I have mentioned few kind of assets and their respective um, tax rates as well. Okay, so now let's discuss what is indexation benefit, which I was mentioned earlier, like with indexation, without indexation. So what is indexation benefit now? So this is a kind of basically adjustments which we have been done on the cost part of the asset. So basically the purchase cost of the long-term capital assets, because of the inflation which has done in the years, we took this indexation benefit. Okay, and because of this indexation benefit, our taxable long-term capital gain will definitely reduce. Okay, because the cost of acquisition will get increased according to the inflation. So your gain will be reduced. So basically you will be paying less taxes, so there will be a tax saving for you because of the indexation benefit. Now, what are the eligible assets for these indexation benefits? So, I have mentioned few assets here, like debt mutual funds, property like land, building, house, gold and jewelry, bond and debentures, unlisted share. These all assets are covered for the indexation benefit. Okay. Now, what is the formula for indexation benefit? So, indexed cost is basically compute by you can multiply original cost to the indexation of the sale year, and you can divide the indexation of the purchase year. After this whole calculation, there will be an amount coming which will be called as a indexation price. Okay, and the capital gain will be computed by reducing this index cost from the sale price. Okay, so here I have mentioned one example as well. Okay, so in this example, property brought in the financial year 1890, the cost was 50 lakh. Now, if you are selling this property in the financial year 25-26 for 1 CR, cost of indexation will be 1819 280, 25-26 is 376. So index cost will be 50 lakhs multiplied by 376 divided by 280, as I have mentioned earlier. And there will be, if you can see here that the actual cost was 50 lakh, but due to inflation, the index cost is coming 67 lakh 14,286. Okay, so now the capital gain is computed 1 CR minus this index cost. So your capital gain is at a lesser side as compared to the original cost. Okay. So basically, yes, definitely, if you are paying taxes on this capital gain, that will be lesser. So you will be saving taxes as well here due to the index cost benefit. Okay. Okay. Now let's talk the exemption and reinvestment strategies. Okay. So basically, there are few sections which is available in the Income Tax Act in which we can basically reinvest our basically the sale, I can say the amount which we got from the sale of the asset, and we can save the taxes on the gain part. Okay, So section, let's discuss these sections. So first section is section 54. In section 54, sale of residential property. If you are selling a residential property and you are reinvesting in your new residential property, you can save your taxes. Here I have mentioned a very, I can say, few details about these sections. These sections are wide and there are so many conditions also which is included in these sections. But I have just basically overview these sections here just to give you all a basic idea about these sections. But if you want to get these benefits, you have to basically go through these sections in a detailed way and you have to satisfy all the conditions as well. Okay. So next section is section 54F. So sale of any long-term asset. You are investing in a residential property. Section 54 EC. The capital gain which you are having, you are investing in specified bonds like NHAI and all government bonds basically. Section 54B, sale of agricultural land and you are investing in the agricultural land. Okay. So here I have written down other conditions as well for 54, 54F and the other section. So for 54 residential property, sale of house applies to the long-term capital gain from sale of a residential property. Gain can be exempt if reinvested in another residential property. Reinvestment timeline is within 1 year before or 2 years after the sale, or if that is under construction property, then within 3 years. Okay. Exemption is limited to the cost of new property. So these are the conditions which you need to satisfy to get the benefit of 54 section. Okay. Now let's discuss exemption under like section 54F. Okay. For any long-term asset, here there is no restriction like 54 of residential property. Okay. So in this this section is applies to long-term capital gains from any assets other than a residential property, because residential house is covered under section 54. This section is other than residential house property section. Okay. Exemption is available if entire net sale proceeds are invested in residential property. Same time less as section 54 cannot claim if you own more than one residential house at the time of investment. Next is section 54 EC, capital gains bond. So long-term capital gain exemption by investing in specified bonds, NHAI, REC, etc. Maximum investment limit is 50 lakh rupees. Investment within 6 months from the date of transfer. Lock-in period will be 5 years. So these are the conditions which you need to satisfy for getting the 54 EC exemption, basically section benefit. Okay. Next is section 54B, that is for agricultural land. Long-term capital gain or short-term capital gain exemption on sale of agricultural land. Exemption if gains reinvested in new agricultural land purchased within 2 years from date of sale, applicable to individual and HUF as well. Small businesses to operate within the GST system. Okay, so these are the conditions which you need to satisfy to gain the benefit of section 54B. So here I have covered all these four sections, 54, 54F, 54 EC, 54B, in which you can reinvest your money and you can save your taxes on the gain. Okay. Yeah. So here I have mentioned few example, like if you are going with the 54 section, 40 lakh rupees of long-term capital gain. If you are reinvesting in new house, you can save 8 lakh rupees of taxes. 54 EC, 50 lakh rupees of investment in bonds, you can save 10 lakhs. These are the rough ideas which I have given here, just to get an idea how much you can save in these sections. If you are going with the 54F, then entire sale proceed invested in the new house, 100% capital gain will be exempted. Agricultural land gain is a new farmland, full capital gain will be exempted. Okay. Okay. So now the final topic of our session, practical tax planning tips. Okay. So I can say these are the few points which I have mentioned here, which is the actual tips to plan your capital gain taxes in a smart way to save your taxes as well. Okay. So you need to identify whether the asset which you are selling is a short-term capital gain asset or a long-term capital gain asset, so that you can decide about the tax as well. Because as I have already mentioned, tax rates are different from the short-term and long-term perspective, but your goals are also different. So for your short-term needs, you can go with the short-term capital gain, but for your long-term needs, you can go with the long-term investment perspective. Next is check holding period and lock-in completion as well. Next is plan timing of sale, year-end impact, because the timing which you are selling is also impact the taxation like other things as well. Select the correct exemption. Basically, you sold the thing, but you are not basically right about, or you are not sure about in which section you will be getting the exemption benefit, which I have mentioned in above. So that is also basically a thing which you need to keep in your mind. Track reinvestment deadlines strictly, because if you are going with the section benefit 54, 54F, EC or B, you have to reinvestment the money within the timeline which we have mentioned in the sections. Okay. Use capital gain account scheme if reinvestment is pending. Preserve purchases, sale, and investment documents. Yes, documents preservation is also important. Ensure accurate ITR disclosure as well. Yes, definitely. You have to disclose all your capital gains, whether it is a short term or long term, everything in your ITR as well, to avoid any kind of notices from the department and other things as well. Okay, so thank you so much for your attention. We are now open for the Q&A session. If you have any questions, feel free to ask them. I'll be happy to answer all of those questions with best of my ability. So, yeah, let's quickly go through the chat. The first question I have is, what is the difference between short-term and long-term capital gain? Okay, so basically short-term capital gain comes from the assets held for a short-term period, while long-term capital gain comes from assets which is held for a long-term period as defined by the laws. Because for the different kind of assets, period is different. So as per the law, whatever period is defined, you have to identify whether it is a short-term or long-term. Next question we have, which types of assets are subject to capital gain? Okay. So basically, there are other different kind of assets which are subject to capital gain taxes like stocks, mutual fund, real estate, bonds, other investments, gold, silver, every kind of assets, property. So these are the basic general assets which are subject to capital gain taxes. Next question we have, do tax rates differ for short-term and long-term capital gains? Yes, I have already mentioned in my today's session. Like for the long-term and short-term capital gain assets, tax rates are different. But I can say for the short-term one, tax rates are slightly higher than long-term capital assets. Okay. Next question we have, when capital gain is considered taxable. Okay. So capital gain becomes taxable when the assets is sold or transferred. In whatever year that transaction has happened, it will be charged to capital gain in that particular year. Okay. Yeah. So thank you so much for today's session. We'll meet in the next session and we'll include another topic in our next session. Thank you everyone for attending today's session.